Welcome to the daily briefing from interest.co.nz. I'm David Chaston. Today we look at the October trade balance, we'll review the latest changes to exchange rates, and we'll take a look at the valuation trends for the PINS product. Finally, we'll wrap up with what the other media are reporting. Record dairy and oil exports are helping our trade balance no end. We continue to spend increasing amounts on imports, and October was a record for this, eclipsing the previous record set a year ago. It is the first time in any month that imports have exceeded $4 billion. Our spending splurge continues. But those exports are the ones that are keeping us able to do that. Milk powder, butter and cheese exports increased $328 million from October 2006, reaching a record value of $878 million this year. Quantities are also up on the previous year, but to a lesser extent, confirming high export prices are being achieved. Recent increases in domestic oil production continue to flow through into exports, with petroleum products up $250 million compared with the same month a year earlier. The net result of these two surging trends is that our trade deficit is about normal. The average for October for the past decade is a deficit of about $600 million, and this October it was $700 million. However, it has to be disappointing that with such strong exports and high commodity prices, we can't seem to make any headway in reducing our trade deficit. When those high commodity prices subside, and they will, there will likely to be a tough adjustment we all have to make. The trade-weighted index of exchange rates for the New Zealand dollar has been pretty stable for the past month or so. That index is currently sitting at about 70 and has been hovering between 69 and 72 since September. But that masks many substantial changes in specific exchange rate relationships with the major currencies. In world markets, the US dollar has been sinking, while the other majors have been rising. Against the euro, we've depreciated 7.5% from a high of 0.54 euro to the New Zealand dollar in early October to about 0.5 today. Against the Japanese yen, our depreciation has been greater. In early October it was almost 90 yen to our dollar. It has fallen to about 80 today, an 11% depreciation. We have tracked the US dollar over this period, showing us firmly in the US dollar commodity camp, ranging between 75 and 77 US cents. But against the Aussie, we've gained quite a bit. At the start of November, a Kiwi dollar bought 83 Aussie cents. Today it buys more than 86, a 4% jump in just 3 weeks. Absolute Capital of Sydney has sold New Zealand investors a series of bonds called PINS. PINS stands for Packaged Income Notes. They're debt securities with exposure to a diverse range of income-producing assets, and they've been recently invoked a clause in their arrangement halting interest payments. There have been 4 sets of sales to New Zealand investors since 2003, and 2 are now left quoted on the NZX. All up, investors have $18 million of these 2 funds, and they promised a 9.25% return over 7 years, and the possibility of a substantial interest bonus. But these are products that are valued on a market basis, and the credit crunch has essentially eliminated any market for their components. This illiquidity has put their management in crisis mode and triggered that interest retention event. As the regular weekly disclosures to the NZX shows, the value of these issues has been sinking. Not only is interest not being paid, the value of the underlying assets of this investment also declining. And not only are asset backing of these bonds declining, the direct values have declined and the prices quoted on the NZX by 1/3, although no one seems to be buying even at these levels. These securities are essentially collateralized debt obligations, CDOs, and this product gives a good indication of what risks investors actually faced when they bought. Finally today, a wrap up of some other items of interest. Our main banks have been accused of a tax rort so massive the sums involved will have an impact on the average taxpayer. Inland Revenue claims the alleged rort involves the banks deciding how much tax they wanted to pay and creating a scheme to avoid the rest, profiting by $1.7 billion. Of course, in true tax law fashion, the IRD doesn't have to prove guilt. The banks are going to have to prove innocence. A Sunday newspaper is reporting that investors are worried that whiteware maker Fisher & Paykel Appliances appears to have chosen the worst possible time to sell its finance arm, leading to speculation about the reasons. The Security Commission is likely to take unprecedented civil action against failed finance company directors next year as it seeks to recover investor losses. You can get more news and start with Newsmaker Views on our news page. Join us again tomorrow for the freshest finance news on the web. We'll see you then.